Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I'm going to be taking a look at what happened in the market and economy during the third quarter of 2024. Markets continued to have strong performance during the third quarter. The Federal Reserve delivered its much anticipated first rate cut in September, surprising some with a half a percentage point cut in rates rather than the more typical 0.25% cut. But in the press conference, the Fed chair explained that they didn't believe they were behind on cutting rates, but they didn't want to fall behind, which prompted the larger cut. Markets were up in the quarter going into the Fed meeting in anticipation of a cut, and then closed out the quarter strong after the meeting. As interest rates moved down, bond prices went up, supporting strong returns across sectors in the fixed income market. U.S. small caps also benefited from lower rates in a soft landing scenario, up over 9% for the quarter. The central banks in Europe were also busy during the quarter cutting rates, and coupled with a weaker US dollar, helped provide support to those international markets. And then finally, we saw investor jubilance really after China's government announced a stimulus package, and that prompted a rally in emerging markets. Looking at real assets, US REITs saw a huge boost in the quarter as falling interest rates and falling inflation created a more positive backdrop for the asset class. Quick check in on the US economy. Things are looking pretty good. We saw that the economy grew at a rate of 3% during the second quarter, which is above trend growth and pretty strong, especially this far into the economic cycle. And we just got the first print for third quarter GDP, which showed the economy was growing at a rate of 2.8%. And that was a bit above expectations and still above that long-term trend of 2%. So inflation is coming down, interest rates are coming down, and right now the economy is still on sure footing. So as we look at the election in the US, we just want to remind you that the stock market has performed well under both parties. So in either scenario, whether red or blue in the past, almost always you would have been better off staying invested in the market rather than selling and going to cash. So if you're worried about the politics not going the way you want, then go vote, but try to separate how you feel about that with what you actually do in your investment accounts. If you want more information on the topic of elections and markets under the political parties, we have a whole webcast where we walk through the data on the economy and the markets under various administrations. So please reach out to us if you want to listen to that. We'd be happy to share that with you. The labor market is still looking fairly healthy. The unemployment rate has ticked up to 4.1%, and while this is up from its cycle low of 3.4%, it is still very low by historical standards. The main difference in what we've seen this year in the rise of the unemployment rate is that we've had so many new entrants into the labor market. So the unemployment rate has been rising due to more people coming back into the labor force and looking for a job and not being matched in the month that they start looking. So this is in contrast with the historical rises that we've seen in unemployment in the past that have typically been characterized by people losing their jobs. So the labor market is showing signs of softening, which is not really a terrible thing yet. It should take some pressure off inflation as we have a little bit less friction in the labor market. And you can see the rate of change in the non-farm payrolls has come down. But in August, we saw 142,000 new jobs added to the economy. And then we saw a big surprise in September with over 200,000 new payrolls added. The chart in the bottom right-hand corner shows that one of the key cohorts in the labor force, so those in the age group 18 to 64, is participating in the labor force at a good rate. And overall, we are at a record high in the number of people employed. So this is something we will continue to watch, but so far there have been no major cracks in the labor market. Turning to inflation, which has been the main theme of this cycle since the COVID recovery, you can see on this chart that we have experienced a tremendous amount of disinflation over the last 2 years. The latest inflation print showed inflation of 2.4% over the past year, with that shelter component still being a bit sticky. But you can see outright deflation in energy costs and core goods, so falling prices in those categories. We have not seen falling prices in the services category as the labor market is still healthy and wages continue to rise. But overall, inflation is certainly heading in the right direction and getting very close to the Fed's 2% target. So this was what the Fed has been watching and waiting for to make that first rate cut. As I mentioned, equity markets were up across the world. You can see the individual country performance at the bottom. The US, of course, has had quite a strong year, and this is actually the best first 9 months of the year for the S&P 500 since 1997. So a really nice return for the first 3 quarters of the year, which has caused valuations to remain quite stretched. So while earnings have been growing, they haven't been growing as fast as the prices of the stocks. So the US market has gotten considerably more expensive, and this is true relative to its own history as well as relative to international markets. Now, this is not to say that we are calling for a decline in the US market. Valuation does not give us any information about whether or not the market will pull back. It really only tells us that returns going forward will likely be lower than they were in the recent past. Still could be positive, and markets tend to go up, especially over time, they go up. But the return expectations going forward will likely be lower than the high double-digit returns we've seen this year. Fixed income is also having a pretty good year. If you look at that year-to-date column, you can see that all sectors of fixed income have had positive returns so far this year. High-yield bonds in particular have had a great year as spreads have been tight and rates have fallen. The chart on the right side has been updated to show the returns for each sector if interest rates don't change at all. Now, the consensus view is that rates will continue to come down over the next year, and that is the most likely scenario, but not guaranteed, of course. So if rates don't change, you can see in the green that returns across the various sectors still look pretty attractive. If interest rates rise 1% for some reason, and that would be a pretty big move up from where we are today, the good news is that we are sitting at high enough rates that the impact to the bond itself is fairly minimal. So the price will go down, but you still get that interest payment, and that is shown in orange. So you can see some sectors still will have positive returns in that scenario, and most will have a slightly negative return. So fixed income still looks attractive, and I think particularly given the asymmetry between rising versus falling rates, we're still in a pretty good spot. This chart shows where the Fed funds rate has been historically, as well as where both the Fed and the market expect it to be at the end of the next couple years, as well as long-term rates. And the good news here is that the market and the Fed might quibble a bit on the pacing of the rate cuts. Right now, they're both in agreement as to where the long run rate will be. So there might be a little bit of volatility as we see labor market data, inflation data. Those things come in that could influence how quickly the Fed gets to the long run rate, but they've done a pretty good job of telegraphing to the market their intentions so as not to create any surprises in the long term. Now, we could certainly get some surprising data around some of these economic metrics, but currently the Fed and the market participants have similar expectations, so no real disagreement about where we're headed, which makes for just a little bit less volatility. So given that we've now seen the first rate cut, one question we explored was what will this mean for the stock market and the bond market over the next year or two? And since we don't have a crystal ball, we look at history to see what typically happens. So these charts look at the rate cutting cycles going back to 1984, and you can see that in most of these scenarios, we saw the S&P 500 up between 10 and 20% during those first 12 months following the first cut. Now, in 2001, the economy was in a recession, and then, of course, the attacks of September 11th happened, and the market really struggled in that environment. The other case of a negative market after the first rate cut was the Great Financial Crisis in 2007. And it became very apparent that the economic problems were very deep, and we needed more than just the Fed cutting rates to stimulate the economy to fix things. But outside of those two sort of crisis scenarios, the stock market has performed well in the 12 months following the first rate cut. The chart on the right shows the basic math of when you cut rates, bond prices go up. So even a 10-year bond, which the Fed doesn't have as much control over, did well during those historical periods when the Fed started cutting rates. The higher that the starting absolute level of interest rates were, the more room rates had to fall. That's reflected in the bond price and the return of the 10-year in the mid-1980s. Now, we will not see anything like that during this cycle since we're starting with rates of 4 to 5% and not 11% like we saw in 1984. But in general, we have seen a couple really good years out of bonds following the first Fed rate cut. And notably, bonds did very well after the interest rate cuts in 2001 and 2007 when the equity markets were falling. So at more normal levels of interest rates, bonds do act as a nice piece of diversification against a recession and a falling U.S. stock market. Wrapping up with a look at real assets, energy had a tough quarter, down over 11%. Now, this might be a bit of a head scratcher for those of you following along with the drama in the Middle East, but OPEC actually decided to increase supply. At the same time, there are growing concerns about global growth. So when global growth slows, the demand for oil and gas goes down, and that's reflected in the prices and returns here. Gold moved higher during the quarter, and you can see that base metals and agricultural products were up a bit, but still constrained by those same global growth concerns. Lastly, the chart on the right shows the performance of REITs. So this is publicly traded real estate. Now, this asset class had some headwinds coming into the year, but really turned around during the third quarter, led by traditional sectors like office, up about 30% for the quarter, but also supported by some of those extended sectors like self-storage and specialty, which includes properties like cell towers, outdoor advertising sites, farmland, and other unique properties. So all in, it was a very strong quarter in the economy and the markets. If you have any additional questions or want more information about your financial plan, please reach out to your relationship manager.